Welcome to the Daily Update, where I'll go over the action in the market from Monday, June 17th, and then we'll see how things look for Tuesday, June 18th. Another day, another new all-time high. Seems to be the statement that can be made pretty much every day, especially when it applies to the NASDAQ 100 and even the NASDAQ. The S&P didn't have an all-time high on Friday, but it did on Monday. We're still seeing a lot of negative divergences. But at the same time, we need to step back and say, okay, this gives reason for the market to really have some difficulties going forward when we see these negative divergences. On the other hand, are we seeing some sector rotation? We're seeing, especially with the S&P, we're seeing growth improving a bit. We're seeing some areas of the market that are really holding up right now. It's still just being led by a small number of stocks. And if you're in those stocks, you're loving life right now. If you're not in those stocks, you're probably pretty frustrated at this point. We're still positive, but we're looking extreme positive. Right now, that looks like it's showing good momentum, but that could change at any time. The market can justify going lower for any reason. We're going to get retail sales on Tuesday, a huge part of the U.S. economy. If that comes in unexpected and spooks the market, that could really turn things around. At the same time, we had a solid up day with the S&P. Interest rates were also up. So we're seeing a little bit of this kind of, we don't care what's going to happen. We're going to buy anyway, and the market's just going to go higher. Now, some of that can probably be explained by short covering, because people that really thought the market was going to go down, they sell to get in. The market goes against them by going up, and they have to buy to get out, and that pushes prices higher. So there's a lot of different dynamics going on right now. It's really hard to take a stance other than, yeah, we're positive. We've got a lot of evidence to suggest that. We could turn negative at some point, but we're not sure how that's going to play out right now, or if it's going to be able to take care of itself and turn the indexes back higher. Please know that I do have a program called the SPXInvesting Program. It has launched. I'm adding new things all the time on there. If you want to check it out, it's free for the month of June. I'll be locking it down in July. If you want to talk to me about this, some of you I've already talked to. I've had some great conversations with folks. Feel free to keep that going. I like to do the back and forth. Sometimes we set up a time on Zoom or Skype or Messenger or whatever tool you use, and we might have an audio conversation or sometimes a video conversation. I'm very open to that if that's something that you want to investigate and actually take advantage of. If you're interested in learning more about the program, there are links in the description below this video. There's also another link that takes you to the SPX Investing website. So you can go check it out, see what you think. It's free. It'll just cost you an email address. If you end up not liking it, just unsubscribe, and that's all she wrote there. Another thing that I've been talking about lately is there's a gentleman named Bob Kendall, and I do subscribe to his daily newsletter. It's $8 a month. It's also on Substack, where I reside. And he has some interesting insights. He's not a perma bear. He's not a perma bull. He's got many decades of experience. I don't always agree with the conclusions that he reaches. That's why I do my own research and analysis. But feel free to check out this YouTube channel, and you might find it useful. What he did is last week, he was putting his indicators on the Fed funds rate. And at that time, it looked like the Fed funds were going to go all the way down to zero. Well, he's since backed off of that a little bit, and this will change. That's the thing with forecasting, to say, well, I think this is going to happen in November, and then next February, this is going to happen. It's all folly, in my opinion. You can do that, and people love that, and they love forecasts, but they're not, I wouldn't base a whole strategy around that. And another problem is we tend to not make our own forecasts. If we do, we rely on what somebody else is saying and what they're concluding, and then we take that and kind of make it our conclusion as well, where I like to make my own forecast, which I don't even forecast. Just to give you an example, I was talking with someone while the market was open on Monday about the program. Last week, before CPI came out, my personal forecast was that we were going to tank after that. These negative divergences were starting to happen. The market was looking a little toppy, and it still is right now, but it keeps going up. And folks like Bob here, he was predicting, and Dan Bird, I believe, he has a free newsletter that comes out. It's like an email address. You just give him that, and then you get a free newsletter every week. And where Bob comes out every day. And I have no connection with any of these people. I'm just taking in their information. But they were both predicting that CPI was going to come in hot. They had done their analysis and they thought, okay, this area is going to rise, this is going to rise, and then CPI is going to come in hotter than expected. And I kind of saw the logic and the reasoning behind that. And I'm like, okay, yeah, I kind of see what you're talking about there. Well, so I figured that, okay, we're going to have a down day. The CPI is going to come in, the market's going to not like it, it's going to come in hot, and we're going to tank. What happened? The exact opposite. It came in friendly, we gapped higher. That's when we broke to the upside, and we set a new all-time high, and then we've been going up ever since then. That's why I don't forecast. Forecast is like fortune telling. Okay. What we do is we look at the charts for what they're telling us right now, because that's all we can go with. That's the only factual information that we have. Everything else is pure speculation. And when you try to forecast, you're going from setting things up in a logical stance and based more on wisdom, in my opinion. And now you're kind of venturing out into la la land where, yeah, what you say could happen, but maybe it won't. I'm not saying don't do that. I develop scenarios all the time. That's what I'm doing through these videos. But to develop some kind of a scenario, whether it's doom and gloom or whether it's we're going to go up forever, it's just, it never works out that way. So if you do forecast, at least be open to modifying your forecasts along the way and saying, okay, I wasn't right about that. All right. I had to do that last week. It's like, okay, I personally, and I didn't even mention this in the video because it's a forecast, but I thought that, okay, we're going to tank. This looks like a logical place for this to happen. Well, it didn't happen. So then you step back and you just say, okay, I need to adjust my thinking here. What were the charts telling me at that time? They're still looking positive. Yeah, there's some negative things to be aware of, but those things haven't started, at least yet, but they could start at any time. Anyway, I don't know why I got off on that. I haven't spoke in a video for a couple of days on things. So let's go back and talk about what happened, and then I will go through the charts. We had a lower open. Futures were down a little bit. Europe looks like they're stabilizing a little bit, at least as far as their stock market is concerned. I have a few charts to show you of that. But we ended up having a lower open and prices fell to the daily pivot at 54.23. That was the low for the day. And if there was ever going to be a sleepy, quiet, low volume day, it would have been Monday. We really didn't have any economic reports. It turns out there was one that I'll go through here in a moment, but not a significant report. And then we just kind of climbed back to the unchanged level, and then we got up to R1 at 54.41. Then as we got into the day, things just started to take off. Prices climbed up above R2 at 54.51, and there should be another bracket there. And above R3, I had to break out the pivot point calculator because that doesn't calculate on my software. We got up to 54.80 and even went above that slightly. And then we closed slightly below R3. So this caught a lot of people off guard if you're expecting a slow day. And again, that was my forecast for Monday, was that I thought we were just going to chop sideways. We have a major report coming out on Tuesday. The market's going to be closed on Wednesday. So why are people going to commit their hard-earned capital into the market with a lot of these variables still out there at this point? Then we were up 0.77%. We had been higher than that, but we came off of that high. We were above average with volume. Again, I thought it was going to be a below average volume day. And I've been doing this going on 3.5 decades. Is that right? 3 decades, a little over 3 decades. I've been teaching almost 4 decades. And so even with a lot of experience in trying to front run what you think will happen, it doesn't, you have to be flexible in things. So we are positive in the short, intermediate, long term. We are overextended in the short term. We're seeing negative divergences, especially in the intermediate term. We're still flat out positive in the long term for right now because of this inflation and interest rate type of thing that's going on. Now, interest rates were up on Monday, but the market didn't seem to really care about that. But there may come a point in time when they do start to care. At the end of the video, I did add France to this list at the bottom. I didn't add it here. So some comments, both the S&P as well as the NASDAQ and the NASDAQ 100 set new all-time highs yet again. The mega caps, that's the real strength of the market right now. The political uncertainty in France seems to be calming down a bit, at least as it applies to the stock market. Now, over the weekend, I tried to watch. Now, I have a degree in political science, and I've taught it, and I understand American government very well, at least the theory behind it. But trying to understand parliamentary type of a political system, I'm like, because they talk about conservatives and liberals and and coalitions and all this, completely different than the American system. And their right wing and their left wing means something different than what it means in the US. And so it's really hard to try to figure out what's going on there. And plus you have these folks, especially from France, who are speaking English with a French accent, and that's can be kind of a challenge too. But I tried to uncover some information there, but I'm just watching this video going, okay, what's going on here? I still don't know what they're saying. There are these negative divergences that are becoming more and more pronounced pretty much every day, and they're just not going away. But we have to ask ourselves, does that mean the market is rotating into other areas? They're getting out of one area, so we're seeing these negative divergences, and they're going into other areas. We don't really know that yet. We have a pretty long list in the short term. The Stochc RSI, the Williams percent R, CCI 1420, the stochastics, the RSI 9, and the boom based on 20 periods. That's the same list that we've been seeing now for the last couple of sessions. Intermediate term, we're still looking extreme with the standard deviations chart. We're up into that +3 channel. The CMB composite, that's been there for a few days. The Sean trend meter, the Chaikin oscillator, the ultimate oscillator, the percent B kicked back in. It was in there for 2 days, dropped out. Now it's back in, meaning that we've closed above the upper Bollinger Band, and the RSI based on 14 periods. So we have the R, and the RSI should be on here for the short term. No, it is. It is right there. So we have both short and intermediate term. We're looking a little overextended. I haven't changed the scenario. The Fed's keeping rates where they're at for right now. If they're going to have a rate cut, the market is trying to figure out if it's going to be September. And I went through that in the weekend videos where I go through the probabilities, and that's going to change. And this is just what the market is speculating. It's not necessarily a really reliable form of predicting what's going to happen. It's just what the market is doing. And so that's why it's behaving the way it is right now. And they're looking at where it had been 6 cuts or so. Now it's whittled all the way down to 1. And even that, we don't know if that's really going to happen. The dollar was down, and that gave some support to stocks, but interest rates were up. We closed at Friday at 4.22 for the 10-year yield. We closed on Monday at 4.28. So that was a fairly substantial uptick in interest rates. We're still inverted with the yield curve. Sentiment still is a negative. And that's because of these negative divergences that we're seeing, because all of these different indicators that are used to calculate this sentiment index, they're trailing off, and they're showing that there's fear in the market right now, where actually it's going against what you're seeing the S&P and the NASDAQ 100 doing. We had been at 38 after Friday. We did tick up. We came up to 42 after Monday, but we're still in that negative area. We're positive with our trend, and it's confirmed. The ADX is above 20. It's above its moving average. The green line's on top. With our bias is positive with the update, and our momentum continues to be positive as well. We had one little report here that wasn't, and when I'm going through the economic calendar, this week is kind of a strange week because they just automatically generate what they think is going to happen. And so we're going to be closed on Wednesday for Juneteenth. And I don't know when those reports that are supposed to come out on Wednesday, when they're actually going to come out. So, and I look at multiple economic calendars, and I'm seeing different things on different calendars. But the New York Fed Empire State Manufacturing Index, it came in at -6. which was better than the minus 13 they thought. And it was actually improved from the minus 15.6 that we saw last time. And here's a chart of that where it's still negative, but it has been improving lately. And this mainly applies to New York. Then some IsabelNet block charts. Don't get locked down in all these crazy little words and check marks and everything. The takeaway from this is 40% of signals are triggered today versus an average of 70% in prior market peaks. You can take that, okay, we're seeing negative divergences. That's the negative side of this. Or you can say this market still has more room to run to the upside before it gets to that 70% level, which is when we usually top out. And this just shows these different indicators that they're using and whether they've been checked off the list or not. And then equity positioning, a lot of folks are getting back into the market, but we're not up to this one level yet. So this could still have more room to go up. Then this is the performance, looking at what's happening with 2024 up to this point and how it's kind of going along with what we saw back in 1995, even late 1994. This is when I first started getting in the markets. It was 93 when I got some books and said, this is kind of interesting. By 1994, this had become my full-time hobby. And then later on, I developed it even further. But 1995 ended up being a pretty good year. And then looking at the forward multiple, and I usually cover that on the weekend, but here was a chart that was available. When you look at the S&P, which is the light blue, we're up over 20 now. That means we're expensive. Even looking forward, we're expensive on a historical basis, and now we're also expensive on a forward-looking basis. And when you take the equal weight, it's been underperforming lately, but its PE ratio looking forward is down around 16. At 15, in that range is when we consider things to be fairly priced. So it's kind of the Goldilocks. It's not too expensive. It's not too cheap. Then looking at the positive earnings per share revisions for the mega cap tech stocks versus the cuts to the rest of the market, this is what the market's in love with right now. Microsoft, Nvidia, Amazon, Google, Meta. Notice Tesla isn't on this list right now. I've even saw some, they should take Tesla out of the Magnificent Seven and put Broadcom in there. That's just, people making noise about things that happen. But this is the strongest area of the market, and they're actually pushing their earnings per share up, where it's pretty much unchanged for the S&P itself. But when you take out the magnificent stocks, I guess there's 5 of them here. There's 503 stocks in the S&P right now, so this isn't quite right. It should be the 497. And we're actually down 5% when you look at earnings going forward. And then this is just some projections. This is the S&P, which is the US, the Stocks 600, which is Europe. And then this is about where we were at the time this chart was created. They think for the S&P, we're going to get up to 5,300. We're going to climb 3 whole points for the Stock 600. By the end of the quarter, we'll be at 5,400. By the end of the year, 5,500. And then they see European stocks actually climbing from that too. But these are forecasts put out by Deutsche Bank. And people just love this stuff, but it rarely ends up turning out the way they think it will. Gold speculative positions. This is kind of a crazy area right now. Now, if you looked at the intermarket analysis video over the weekend, you're seeing where gold is not outperforming the S&P. If anything, they're performing about the same. There's little blips up and blips down, but you would have been better off just staying in the S&P. I know there's a lot of gold folks out there that, oh, this is it. We've been waiting decades for this. Well, while you were waiting for decades, the S&P was just humming along doing just fine. I did find some interesting charts on Twitter. I was able to just kind of grit my teeth and spend some time on there. This is Buying American. This is a cumulative return going back to 2009. This is the S&P, which is in black. It is the leader on the globe. Then we have the EAFE over here in pink, where it's respectable. And then we have the emerging markets over here, which are falling behind a little bit. This is just a comparison between different areas on a global perspective. David Keller sent out an interesting tweet. He sent out a bullish one and a bearish one, where he's saying market bears need to wake up and realize that even though breadth is weak, the benchmarks just keep going higher and higher as the mega caps are leading. Then at the same time, he sent out a different tweet that said market bulls need to wake up and realize the breadth remains weak and bearish divergences are everywhere. That's how you can interpret things these days. You can take a positive stance or a negative stance. He ran a little experiment. He said he sent out a bullish tweet and then a bearish tweet right at the same time. And just to give you some stats on that, the bullish quote, he got 35 likes and 3 retweets. The bearish quote, he got 59 likes and 7 retweets. Oh, are you a perma bear? Are you a perma bull? That's kind of what he was trying to find out here. And looking at something from Lance Roberts, which is real investment advice, there's something called the hopes and dreams ratio. Okay, and it's at the highest since it's been back in 2000, which I'm not really into that, but it's getting pretty high again. It's the difference between the current value of the market that is not explained by underlying fundamentals. In other words, this is the premium investors are paying for equities, and it's getting to kind of a high level right now, and so that could be a little dangerous. And then Jay Capel just put up this tweet here. It says the NASDAQ 100. And the reason why I'm focusing on the NASDAQ 100 is I don't do that index myself. I do the S&P. But a lot of you that watch these videos do things with the NASDAQ 100. And the NASDAQ 100 has a huge impact on the S&P 500. So it's up another 300 points. Will this rally ever end? Of course it will. Will you or I pick the top? People try. It's kind of like picking a bottom. You end up with stinky fingers. Well, picking a top can make you look kind of foolish as well. I can only answer for myself. Jay's trading maxim number 214, identifying reasons why the market should not be rallying is much easier than identifying when it will stop. And just like it was Keynes, the economist, said that the market can remain irrational longer than you can remain solvent. And if you're shorting the market right now, you're feeling some pain. If you're long the market right now, you're really enjoying this as long as the party keeps going on. And then this is Jason Gepfert from Sentiment Trader. It says nearly a quarter of all 1-month peaks in the NASDAQ 100 happened in July. And that's what he's pointing out here. That's twice as many as any other month. Quite a few factors lining up for a short to medium term peak soon. Now, this is historical. This is a kind of a forecast. We don't really know what's going to happen here, but this is what has happened in the past. Then he also posted another thing. The RSI on the triple Qs is on track to go above 82 for only the 7th time since the Qs were invented. They came after the SPY. So you can see down here, and I have a couple of RSI charts that I show, but we're getting up to a really high reading here. Mixed as a short signal over the next month or so, terrible for shorts after that. So we might bump up here, get a little extreme. That might push the market down a little bit. But then after that, because it also suggests there's good momentum, it means what he's saying here is that after that is when the NASDAQ 100 really starts to shoot higher again. And you see this tweet right here is kind of more negative. This tweet here is more positive. And these are very knowledgeable people who are coming to different conclusions based on the same information. He also posted this. The NASDAQ 100 continues to notch record high after high. Many of its stocks are not only lagging, but they're falling to monthly, quarterly, or even yearly lows. And this is part of the negative divergences that we're seeing. And I'm pointing this out in the S&P. We're making highs with the NASDAQ 100, but when you look at the breadth, it's trailing off. Both above its 10-day average, 50-day average, and 200-day moving average. I use a 20-period moving average instead of a 10. And he says, this is not normal. In fact, it's never happened before to this degree. All right. There's a possibility that the average stock will catch up. When I mention rotation, maybe that's what's going on. That means that there will be a chance for this to actually catch up. That is not how things usually pan out, though. But we just have to keep that in the back of our mind. It was late December 2022 when we were correcting by going sideways. And then going into 2023, the market really had a good run up at the beginning of the year. There wasn't a pullback. We consolidated sideways. Well, maybe some of the consolidation is happening between the sectors now. Not saying that's okay. I'm not saying that's what is happening. I'm just saying that's something that could be happening, and we need to be open to that. Let's see. But that's not how usually things pan out. Almost never, in fact. Risk is high in that index. So here you have Jason Gepfert, Sentiment Trader, the same organization, pointing out negative things and positive things at the same time, which is what I do. And then I let you decide. And then Bar Chart came out with its cash levels at investment funds. Now, these are money markets, but this is where you park money before you put it into the markets. And it's getting to a really low level and it's dropping below the average. And that means a lot of folks are trying to chase this market, and this could end up being negative. In fact, he says, uh-oh. So we'll just have to see what happens with all of that. And then to give you just a clear picture of what will happen, Goldman Sachs gives its 4 scenarios for the year end. They say we're going to go up or we're going to go down. Okay, I'm not sure what the third and fourth one are, but make sure you make note of this headline because they're telling you everything you need to know here. I hope you're writing this down because either we're going to go up or we're going to go down. Now, how insightful is that? Okay, completely useless information, even though it's correct. Let's go look at our charts where it looked like it was going to be a slow day. We actually ticked down a little bit. We went just a little bit below the daily pivot, but we set the low right after the open. And then we got back up to the unchanged level, kind of danced there again, looking like it was going to be a slow day. And all of a sudden, we started to break above R1. We danced along that. Slow day, right? Well, then we ended up just shooting up to R2 and above it. It's like, okay, things are getting kind of interesting now. And then we just trailed higher with a steady climb and we got above R3. And then that's kind of where things topped out. I thought we might hit R3 and maybe hit that as resistance and come down a little bit more. No, we actually went above R3 and then stayed above it. And then right going into the close, we did see things trail off slightly. Here's our intraday chart. Nothing really all that obvious that we're seeing here, but we are looking good here when we look at growth versus value intraday. The blue line is above the red line. Intraday, we're seeing an improvement with growth to value with the S&P intraday chart here. It trailed off near the end, but if you go all the way back to the beginning of June, you see how we've been climbing higher over the longer term, and that is showing an improvement. With our end of day charts, growth was up and about half as much value was up too. Growth was up more for the mid caps and it was also up more for the small caps. So looking at our end of day charts, yeah, a little bit of a tick up here, but not any real convicted strength. A little bit of a tick up here, but a long ways to go to look better. This is where we're seeing more of an improvement. The growth to value ratio for the S&P. It is breaking out above these previous levels and continuing to go higher. We were really concerned about that. This was really lagging behind even as the S&P was going up. Now we're seeing a little bit more of a shift back over to growth. At least that's what it's looking like. Look at this growth to value ratio here. This just continues to go up, showing the growth is outperforming. Not seeing much of an improvement here with discretionary and staples. Staples ended up being up where discretionary just kind of not all that much. So the ratio was pretty much flat. It's showing an improvement, but then we fell back after Friday and we went sideways after Monday. Large cap growth setting a new all-time high. The large caps are continuing to outperform the small caps. The Wilshire setting a new all-time high, a broad market measure. Our trend is looking more positive now. The ADX is above its moving average and above 20. That's a confirmed trend. It's a positive trend because the green line's on top and now the green line is actually going up. And we're seeing an improvement here in the short term as well, as we're seeing more of a confirmed trend now, positive trend in the short and intermediate term. Volume still, it's improving from where it was, but we were above average on Monday's session. Sentiment, here's the weekly chart. We're coming in at 74.12. We're right on the verge of greed over to extreme greed. Where the chart that we look at, it's like way down here in the fear area here. So we're getting a real discrepancy between these charts. Here's our insider transactions ratio. This is what we look at to see the legal insider buying or selling. It's actually dropping down a little bit. So that can be a little bit more bullish. Looking at the insider buying ETF, it's not really breaking out at all. You can make a series for it. It has to break out here with this trend line, but it's been holding up to this point. Consumer confidence, that came out on Friday, and that kind of shocked the market. People aren't as happy as they're supposed to be, and we saw folks feeling a lot less optimistic about things after Friday's report. The Ulcer Index is declining and below its moving average, showing there's not a lot of fear. We don't have the latest reading from Investors Intelligence. We are coming in above 3 currently. We actually ticked up here with the closing value of the VIX, and we also closed near the bottom of the bar when we look at the VIX here. But to see this go up on an up day, kind of interesting. And we're seeing a little bit of a pickup in the volatility of the VIX. That's starting to increase, at least on the bar chart. It actually declined a little bit on the line chart. This is still on the books. We have the skew index where the VIX uses at the money options. The skew index looks at out of the money options. We spiked up into this red area. We had the big up day on Monday, and now this is falling down, but we're still in the red area. So we're wondering, is this going to mark a continuation of the upward thrust? This could change at any time, but this is what it's telling us right now. We are seeing a little bit of a turn up with the MACD when we measure the momentum of the VIX. So it's actually going a little bit higher. We saw a bit of a tick up with the equity put call ratio. We also are going back up with our 5-period chart of the equity put call ratio. The volatility risk premium is above the band. See, you've got some fear out there, and there's some people that are hedging. That's why these readings that we're getting, that's why we saw the VIX go up on an up day. They're buying more puts than calls, or they're with the VIX, they're positioning things to actually decline. With the equity put call ratio, they're buying more puts. So that's hedging. We're seeing this going up as well, as we're seeing the volatility risk premium really picking up currently. And we went up with this fear gauge, but we went down with the other fear gauge. These two haven't really been in lockstep with each other lately. We're still seeing this negative divergence based on price, setting an all-time high with the S&P, and price is trailing off. We're holding up a bit better here with volume. We're not breaking out, but we're not falling down the same way that we are with price. We did see an expansion of the new highs, and that's encouraging. Not enough yet to really turn our 5-period back up. We're still declining slightly with our 10-period moving average. We're showing an improvement here with our 19 and 39-day advanced decline ratio. It did tick up, but they're both still negative. This is one of the stronger indicators right now. And over the weekend in the weekly video, so what to watch video, I compared the daily chart with the weekly chart, and they're both confirming each other. My concern is that maybe we're getting a little far away from this moving average. This is like the boom indicator. When we get far away, this indicator will have a tendency to snap back to the moving average, but I don't really have a way to measure that based on how stock chart sets things up. This is a smart money institutional indicator that is still looking quite positive. We saw a little bit of a decline with the Chaikin money flow, but it's still positive. So a little bit of a warning there to have it go down on an up day. Chaikin oscillator continues to go up, and now we could go higher. And if we get up to this green area, that might mean that we're getting a little more extended to the upside. We saw a bounce off the 50-day moving average with the cumulative NYSE advanced decline line. That's rather encouraging. A little bit of a tick up with our regular NYSE advanced decline line. A little bit of a tick up with this other NYSE advanced decline line. We ticked up with the common stock advanced decline line for the NYSE. We ticked up even a little bit less here based on volume, which is kind of surprising. We've been seeing volume holding up better. Didn't do so on Monday for the NYSE. It is still holding up where we're setting new highs with the S&P. We're just trailing off with the cumulative advanced decline line for the S&P. We're still hanging out near these highs with the cumulative advanced decline line based on volume for the S&P. This is another newer chart. I've been watching it for, my gosh, years, but I didn't think it was really telling us all that much. Now I think it is. Where the bar chart that you see is the S&P. Not with the S&P advanced decline line. This is the NYSE advanced decline line, and we were seeing a real negative divergence. The S&P was going up as the NYSE advanced decline was going down, and it still is, but it did tick up a little bit on Monday. We're seeing a little bit of an improvement here with our advanced decline line studies. We're turning back up. It's still below the moving average with the common stock on the NYSE. We came back above the moving average with the S&P, turning up, but still below the moving average with the mid caps as well as the small caps. Our daily chart, we're still above this pivot level. If we keep going up, we might have one of these other pivot levels to deal with. And if we start to fall, we'll be watching this upward sloping trend line. We'll be watching this pivot point. We'll also be watching the 50, is that right? Yeah, the 50-day moving average. I'm also keeping a close eye on the 20-period moving averages on other charts. We are extreme with the Stochc RSI, the Williams percent R, the CCI 14, the CCI 20. The stochastics are extreme on all different time frames. This is one of the 20-period moving average studies. We're above this and both lines are going up. The short-term trend continues to be positive. We're turning back up, but still showing a bit of a negative divergence with our 20, 50, and 200-period moving averages of the S&P. The force index is looking a little bit more positive and not necessarily extreme. This is the other main moving average that I'm keeping an eye on. We're well above it, but if we start to pull back down, we might see if this provides some kind of support. If we break through that for some reason, then we're probably going to go down to the 50s. We are in the +3 channel with our standard deviations chart, so we're looking extreme there. The boom indicator shows that we're getting far away from the 20, even a little bit far away from the 50-period moving average. We're still looking positive with our distance away from the 200-day moving average. The balance of power is going up, and that's positive. The go-no-go is positive. The highest high value is positive. TTM squeeze is turning back up. That's positive. The 50-period double and triple exponential moving averages, that's positive, and we're starting to see the red line crossing above the blue line. That's what we saw coming out of the lows in last October. That's when we were just going up something fierce. We want to see that continue to be above the red line, above the blue line, to show that there's more conviction behind the move. CMB composite is still extreme positive. The ease of movement is positive and above zero. The Erin really trailed off here. Then this is its own funky little indicator, so we can't really base everything around this. But here we are setting highs with the S&P. We did see an expansion of the buyers, but we're seeing a real expansion of the sellers. And the difference between the two is the oscillator down below, and this is really dropping off after having been extreme positive. This is also one of the negative divergences that we're seeing. The S&P McClellan oscillator is below zero. It did tick up, but it's negative still. So our summation index based on price and volume continued to decline. You see a little bit of a turn up here based on volume. We need to see something more pronounced that we can really pick out and see changing before we're committing more to that. Also, the NYSE McClellan oscillator ticked up, but still below zero. That's negative. So we continue to decline with the summation index for the NYSE based on price as well as volume, and actually a little bit of a speed up here when it looks at volume, which is not what we were seeing a few days ago. Swenlin trading oscillator based on price and volume. We ticked up based on price. We continue to go sideways based on volume, but both are negative. Momentum, though, looks like everything is just wonderful with the PMO going up, but when we break it down a little further, we are declining based on price and volume. Our studies showed a little bit of an improvement with the PMOs that are rising. These are stocks inside the S&P. We ticked back up just a little bit, but we've been going sideways at best lately with the buy signals. We're flattening out, but still kind of declining when we look at the PMOs that are above zero. Not showing an awful lot of strength as the S&P is setting all-time highs. We are positive on a trend basis, though, with the Elders Impulse System. The parabolic SAR is positive. The slope oscillator shows that short-term momentum is positive. The MACD shows that intermediate-term momentum is positive. So looking at all of our different oscillators across the short, intermediate, and long-term, we are positive on a momentum basis. We're above all the plotted moving averages here. That's positive from a trend perspective. But we're not seeing anything all that great when we look at the bullish percent index. We're positive since we're above 50, but we're just kind of blah, 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 not really breaking out. It's not really confirming these highs that we're seeing. That's another negative divergence. The NYSE bullish percent index did decline, but it's still above 50. Another negative divergence that we're seeing. The NASDAQ 100 bullish percent index, it is positive now. It crossed back above 50, but we're actually flat, even though the NASDAQ 100 set a new all-time high. The money flow, looking extreme positive. The ultimate oscillator is extreme positive. The vortex is positive with the green line on top. Here's where we're looking extreme with the RSI 14. That's intermediate term. The RSI 9 is more short term. We are getting extreme readings on both. On balance volume is positive because we had an up day and we're above an advancing moving average. And when we look at the stocks in the S&P above their 20-period moving averages, yeah, it came up, but we're still below 50. So this is still a negative divergence. We're wondering if we're going to see some more strength here after we saw this initial upthrust with the 20-period study that we're doing. But we saw an uptick, but we're not seeing a real breakout at least yet. But when you compare it to what happened in March of 2023, We thrust up, came back down, chopped around for a little while, and then it was later on when we saw the indexes really start to take off. We're wondering if something like that could happen again this time. We did tick up with the stocks above their 50-day moving average, but we're still below 50. So that is negative and another negative divergence. We ticked up another negative divergence here with stocks above their 100-period moving average. And we tick back up, and this is actually a little more positive since we're above 50, but we've been seeing this trailing off as the S&P has been going up. The copy curve is now turned back over to positive. This is another momentum oscillator. The Sean trend meter is extreme positive. The standard deviation is kind of flattening out here, but it's still above its moving average, showing that we've been going up fast. Standard deviation in this context goes back over the last 10 periods and measures speed, not direction. We are coming back up above this upper Bollinger Band here now, so the percent B is now extreme positive. We're looking a little bit better here with a 5-period moving average of the highs minus the lows across the broad market, but we're still negative. We're getting a reading of minus 109. And now this is what I brought out late last week and over the weekend. We're a little bit above this R2 level. We didn't hit this level, turn and come down like we did other times along the way. Now, this is a weekly chart, so we're really not going to know if this is positive or negative until after Friday. We need to close above this R2 level to have that validate that we're going above that particular pivot point. But when you look at the trend, looking great with the hike in ASHI, with the Kagi chart, the Renko chart, and the 3-line break chart. We're seeing a little bit of improvement, but we're trailing off here. As the S&P is going up, we're seeing the 150 and 200 period moving average is actually showing a negative divergence more in the long term. We do not have a confirmation yet when it comes to the Hindenburg-Ullman indicator. We have to get through Tuesday, June 18th, which means since the market's closed on Wednesday, we're not going to get this chart updated until Thursday. So it might not be until Friday what we actually know what's going on here because there's a lag. This reading is from Friday, and I'm doing it after Monday. You throw another closed day in there. So we'll have to see. Now, the Perma Bears, they're just sure this is going to be confirmed, and it may be, but we're not seeing that yet. This is just showing Friday's move. It's not showing Monday's move up. Now, I did break this out and I showed it over the weekend where we are seeing Hindenburg-Ullman's when it applies to the NASDAQ, not the NASDAQ 100, but the NASDAQ. But look at this. We were getting all kinds of confirmation signals since the beginning of 2024, additional spike ups here, spikes up, spike ups, and we're getting some now. But look what the NASDAQ did. So yeah, look at this. I mean, this thing has just been going really, really well lately. So this signal, it's like, can we trust this? That's why I don't base everything around one indicator. We are looking negative still with the mid caps and small caps in the short term, and we're looking a little more negative in the intermediate term. Everything else is positive. We're still looking negative based on price in the long term with bonds. Everything else is positive. No changes on the decision point scorecard. We set a lot of positive things up on Monday where the NASDAQ got above 17.7, the S&P and the NASDAQ set all-time highs. The sectors, we saw discretionary. That's what we want to see if we're going to get more positive and see growth really doing better. And tech, these are two big areas. Now, it would have been nice if communication had done better, but it's been doing quite well on its own, and it was still up. Staples were up again. That's a little bit of a concern. We're keeping an eye on healthcare. That's more defensive, and that was going down. Real estate, which seems to do nothing but go down. Utilities are showing a little bit of trailing off now. So we're still keeping an eye, especially on staples and utilities with a third eye on healthcare. You know, like mothers always have a third eye. All right, we're still negative here. When we look at the new highs minus the new lows on the NYSE, we're down to -9, showing an improvement, but still negative. When we look at the equal weight and compare it with the S&P, we ticked up just a little bit, but there's still a negative divergence here. So we're actually continuing to go up with this ratio, meaning the mega caps are the ones that are really leading things higher. The Dow had an update, but we just stopped right at this pivot point. We're just barely above its 50-day moving average. So that's showing some improvement, but now we're at overhead resistance. The diamonds have gone from being negative back over to positive with the Elder's Impulse system. The NASDAQ came up to this R2 level and closed down below it. But the NASDAQ 100 actually closed a little bit above this R2 level. And these pivot points can be pretty important when it applies to the NASDAQ and NASDAQ 100. So we're going to keep an eye on this. We are positive with the Qs when looking at the Elders Impulse system. The momentum for the NASDAQ 100 is positive. The small caps, they were up almost 1%, but now they're just coming back up into the middle part of the range they've been in for 2024. They have gone from being negative over to neutral with the Elders Impulse system for the small caps. We're still below the 50-day moving average with the Russell 2000 small caps. We're turning back up, but below 50 with the RSI. The momentum still continues to be negative. The mid caps, not really showing an awful lot of strength. They were up 0.89%, but still below their 50-day moving average. We want to see this area improve because it did earlier in the year, and that gave a lot of support to the market. But we did change from being negative back over to neutral with the Elders Impulse system for the mid caps. Apple just seems to be the darling stock these days. It was up 1.97%. Tesla seems to be in the doghouse, even though it jumped up over 5%. It's still above its 50-day moving average, but we're still seeing a longer-term downtrend here. NVIDIA was actually down just a little bit as some folks were finally starting to take some profits. Microsoft was up 1.33%, setting all-time highs. Meta, not to all-time highs, but it was up a little less than 0.5%. Amazon was up about 0.25% and starting to get back above its 50-day moving average. Google was holding up quite well, up 0.25%. Netflix was up 0.96%, not setting an all-time high yet, but looking a lot stronger here. The FANG index setting a new all-time high. Financial sector showing some improvement here. We were getting a little bit concerned as we were dropping below the 50-day moving average, and the blue line is starting to roll over. If we can get back above the blue line, that will help things improve. And the staples to tech ratio is continuing to go down. That's positive. That means staples are underperforming the tech sector. The dollar, even though it's up here, it was actually down slightly in the cash session. And we're seeing a real trailing off here when we compare the S&P to the rest of the world. Short term, they're really not going in the same direction. Seeing a little bit of a deterioration here with the longer term correlation. And I want to include some charts of France. This is the CAC 40. That's their main index. We came down and actually broke below the 200-day moving average. Now we're trying to come back above that. When you look at this, though, we had been in an uptrend, and the French market has been doing pretty well these days. So we're wondering if it's going to be able to resume its uptrend. Here's a look at the ETF that follows France as well. It came down to its 200-day moving average and is still above that. So, and because it's international, that's why we see some of these gaps here. It doesn't trade according to US hours. The staples sector was up 0.95% and bouncing off its 50-day moving average. That's a little bit of a concern to us. Utilities were down over 1% and coming back down to their 50-day moving average, but they're still in an uptrend. Healthcare was down slightly, and it's been starting to chop sideways. So the staples, the utilities, and the healthcare areas, those are the defensive areas that we've been keeping an eye on. Energy, we don't know if that's really a defensive area or not. It came down to its 200-day moving average, and it's now bouncing up off of that. The reason I say that is there are times when it's more defensive, like if a geopolitical event happens. But if it rises based on market conditions, that can be positive. It can actually support the market going higher. Total U.S. stock ETF, setting a new all-time high here. And looking at interest rates, we did tick back up with the 10-year yield, which means we were down with the 10-year based on price. We're still looking good here, thinking that the market is pretty much anticipating a soft landing, meaning that we will not go into a recession. This is also positive, showing that bonds are underperforming stocks. We want to continue to see that ratio going down. The Qs are outperforming 3 to 7 year bonds. That's positive for the Qs. The tech sector is outperforming 3 to 7 year bonds. That's positive. The S&P 1500 is outperforming shorter-term bonds. That's also positive. And we have another broad market measure outperforming 3 to 7 year bonds. So that part is holding up. And then looking at our growth to value ratios, looking much better with the Qs to S&P, looking dismal with discretionary to the S&P, looking quite strong when we compare large cap growth to large cap value. So with the large caps, we're looking better, a bit of an improvement with the mid caps, and we're pretty much sideways, but above the moving average with the small caps. This is showing an improvement. We're still negative with the 19-day advanced decline ratio based on price. We're starting to climb back above zero and turning positive based on volume. The S&P to utilities ratio continues to go up, and that's positive for the S&P. The staples to S&P ratio continues to go down, and that is positive for the S&P. So what's our outlook? The stock market will be closed on Wednesday, June 19th for Juneteenth. We are positive, but these negative divergences are still there. But we're wondering, is this some kind of rotation that's going on in the market? We're going to get retail sales, industrial production, and capacity utilization. At least that's what's scheduled to come out. We're also going to get business inventories. And I added France over here to the list. I don't know, the French, they kind of overreact sometimes. But we want to put it on the list because it was having an impact on European stocks, which were potentially having an impact on US stocks. And then I have this in blue right here because I don't know when these are going to actually come out. Then Thursday, we're supposed to get jobless claims as always, and we're going to get some leading indicators, housing starts and building permits, and we're going to get the leading economic index on Friday. But I don't know how this is going to be adjusted as we play things out. So this is the big day for retail sales, and that could really impact the market. Seasonality, we're neutral to positive across the board on June 18th here. And Tuesday is kind of non-committal with a slight negative bias based on what we did in 2023. We're looking a little bit positive here during an election year with the green dash line slightly going up. And when we get into Tom Bowley's research, we're just starting to come out of this positive part. That was the 17th. That was Monday. Now we're starting to come into what he has found to be more of a negative time seasonally. So the warning signs, we're still keeping an eye on staples and utilities as well as energy and healthcare, just to see if they really start to show some strength, especially staples and utilities, because that's what happened at the end of 2021 before the market was getting ready to really go down. The advanced decline lines, they're improving, but they still continue to show weakness across the board. We're still going up with the 5-period equity put call ratio. Growth to value is really improving for the S&P. I could have put that on the positive side, but I want to see more follow through. Where discretionary to staples, it's not really doing all that well. Our McClellan oscillators and summation indexes for the S&P and NYSE continue to be negative. We're still negative with the Swenlin trading oscillator. We're still looking more negative with the 20, 50, a little bit of an improvement with the 100, but not much with the studies of those stocks inside of the S&P. So the positive side, we're still looking good with the parabolic SAR, our 3 smart money institutional indicators, accumulation distribution, Chaikin money flow, and the Chaikin oscillator. They are still looking solid, even though we saw a little bit of a downturn with the Chaikin money flow, but it's still positive. We're looking positive on a momentum basis when we look at our oscillators. We're above 50 with the bullish percent index, but we're just chopping sideways now. The money flow, the ultimate oscillator, the vortex, the Copic curve, the financial sector, it's showing some weakness here, but it could be coming back up to its 50-day moving average. With the NASDAQ 100, the momentum is positive and the bullish percent index is positive, even though it went sideways on Monday. So our conclusion, we're positive right now. We still have to respect these negative divergences. Is rotation going on that's going to take care of this? We don't know at this point. We just want to watch. In the short term, we're positive, showing some improvement as we're going up. On one hand, you could say we're overbought, we're overextended to the upside, but you could also say, no, this is just showing good, solid momentum, man. And then intermediate term, we're positive. We see more negative divergences there. Is that rotation that's happening? Seeing some slight negative divergences compared to the 200 and 150 period moving averages with the long term here, but we are still positive. Thank you. I hope you have a great day, and I will talk to you in the next video.